Very quickly. Nothing dietary restriction for you. Some dietary restrictions like Peruvian policy.
It's next week. They're coming on April 11th, right? April 11th. Like, yes. I didn't even know that. Okay, folks. So you know which session we're in now? Anybody have a count? We have 26 sessions in the semester. Know which session we're in? 17. So we've spent 16 sessions on the investment principle, right? So collectively, we have really only 9 sessions, because the last session is a review session on financing and dividends. And you're saying that's disproportionate, but I think it actually should reflect how we think about businesses. Here's what I want you to think about. Think about any great company, and then ask yourself, and you can pick whichever one comes to your mind, ask yourself, how did this company become great? Did it become great by finessing its capital structure or optimizing its dividend policy, or do companies become great by picking great investments? It's a slam dunk, right? I can't think of a single company that got to the top because it had a better mix of debt and equity, or that it had a better buyback policy than other companies. You get to the top because you took great investments. Remember the Miller-Modigliani theorem? It said investments are what drive the value of the company. Even if you don't believe the theorem, I think the message should still come across that if you're a company and you think about how do I turn this company around? How do I make this a great company? Investing is where the process starts. And for those of you who end up going to work for an investment bank in corporate finance, here's a very humbling aspect of corporate finance and investment banks. What aspects of corporate finance do investment bankers provide help on? Mostly financing and sometimes dividends. Because in investing, there's not a whole lot. An investment bank can't come in and say, you should create a new iWatch or a new product. They don't have that capability. So at best, you're fixing these problems that are symptoms. If there's a company which makes bad investments, you can hire the best investment bank in the world. You can optimize your capital structure. You can do the perfect dividend policy, but you're already sunk. Conversely, if you're a company that takes great investments, you have an incredible amount of slack. I mean, you take the Fangam stocks during their glory days, right? Fangam is Facebook, Amazon, Netflix, Google, Apple, and Microsoft. Those 6 companies accounted for 16% of the increase in market cap of all US companies, that 7,500 plus companies. 1 out of $6 created in the last decade came from those Fangam stocks. None of those stocks optimize capital structures. You knew their optimal debt ratios. They're, I think, all under levered. Maybe Netflix is close to zero, but every other company is significantly under levered. We know that none of them optimizes dividend policy. You know how we know? Because the cash balances are 100 billion, 150 billion, 200 billion. How do they get away with it? When you make 40% returns on your projects and you create value, nobody cares that you don't optimize capital structure. You get that slack forever? There's more talk now at Facebook, and maybe you should borrow more money, and maybe you should look at your dividend policy. You know what that suggests, right? If you lose faith in a company's capacity to take great investments, that's when you talk about, hey, how should we borrow money? How much should we borrow? So I'm not saying financing and dividend policy don't affect value. Obviously, I wouldn't be spending time on it. And you can make some horrendous mistakes on these two that pull down great investments. So you can be a company that has great investments, and if you screw up on financing and dividend, you can drag the company down. But I want to keep perspective that this is something that can change value, but you have to start with good investments. So today I want to start on the discussion of debt and equity, and in fact, at least lay the qualitative trade-off that drives the decision. So we're going to spend the next 4 or 5 sessions talking about the financing principle. There are 2 questions we need to answer, right? What is the right mix of debt and equity for my company, not for all companies? And the second is, what's the right kind of debt for my company? Straight debt, convertible debt, fixed rate debt, long-term debt, short-term debt, dollar debt, euro debt, all these choices, corporate bonds or bank loans. So to address that question, I'm going to start by drawing a distinction between debt and equity, which is very simplistic. Of course, on a balance sheet, accountants make this distinction, but I'm not sure that that distinction always holds. So here's the way I think about the contrast between debt and equity. And I want you to step back whenever you look at companies with complicated financing and use this framework to think about, what should I put in debt? What should I put in equity? You've had to already confront this question when we did cost of capital and say, what should go to the debt and what should go to the equity? Debt provides you with a contractual claim on the company. Equity is a residual claim. Second, if you think about debt, debt gets first priority if you go bankrupt and you say, who gets the assets first? So debt is a contractual claim. It gets first claim on the assets in liquidation. This is good, right? But in return for giving equity investors a residual claim, usually give them control of the company. They're the ones who pick the board of directors. They effectively run the company. And this goes back to the first question, maximize shareholder wealth, and shareholders are going to run the company. There's also a tax code issue. And this is something that was imposed. And maybe we need to think about why tax codes around much of the world have been written this way. But the tax code, for whatever reason, seems to favor debt over equity because those payments you make to lenders, interest payments are tax deductible, but the cash flows that go to equity investors in much of the world, dividends and buybacks, have to come out of after-tax cash flows. So as we look at balance sheets, that's the question we should be asking. Where do I put them? And sometimes you'll run into securities. So I don't know where to put that. Convertible bond, a hybrid security, which is somewhere in the middle. So the real question we're asking is, between debt and equity, what is the right mix for my company? What are the advantages of using one versus the other? So as we look at this question, let's lay the groundwork of thinking about, how companies borrow money. For some reason, again, my remote's slipping. Let's look at patterns in finance. So this is an update from 2022. Here's what I did. I went across the world looking at companies, and you find the information in the statement of cash flows, right? There's financing cash flows. And I looked at how much of the financing in companies comes from debt issuances, how much comes from equity issuances. And let me pause right there. If you look at debt versus equity issuances, the debt is the red part of the column. The black is the equity part. Around the world, it's a no-brainer, right? Lenders, debt issuances vastly outnumber equity issuances. In fact, once companies go public, it's very seldom that they go back to the market to issue fresh equity. That doesn't mean they don't use equity, because there is a second way in which you can use equity, which is retained earnings. Retained earnings is internal equity as opposed to external equity. Now, I'm not going to read too much into this, but after we've done the trade-off, you might want to think about why are the mixes different in different parts of the world. Now, if you look also at the kind of debt, there are 2 ways in which you can generically borrow money. One is from banks, which have been around for hundreds of years. And the other is in the form of corporate bonds, which has been around in the US for 150 years. Much of the rest of the world, it's much more recent. Last 4 decades or 5 decades, you've seen corporate bonds. if you went back to the 1990s, US companies were pretty much the only ones issuing corporate bonds. Even European companies stayed with bank loans. So I want to pause right there and think about bank loans versus corporate bonds. Many companies today, even mid-cap companies, have the choice of using either. So you're a company, you want to borrow money for the next 10 years, you can use a bank loan or you can use a corporate bond. Which one is the better choice? Or is that a trade-off? Anybody want to give that a shot? What's the advantage of using corporate bonds over? Let's start with corporate bonds over bank loans. What is the advantage of using corporate bonds over bank loans? Well, you have interest payments on a bank loan, you have coupon payments on a corporate bond. They're both interest payments.
But in the corporate bond, normally you're going to pay all the debt at the end.
So one is, you might get a balloon payment loan with a corporate bond. But that's, kind of neither here nor there, right? Because even companies with corporate bonds often set aside sinking funds to pay off the principal. So, but it's not just that you get a balloon payment with corporate bond, you also get more flexibility. In what form? You can take corporate bonds, you can add special features, you can make floating rate, you can make it convertible, much more difficult. If not, it's not impossible, much more. So you get more flexibility in how you structure it.
Gives you more leverage because if the bank already.
Let's not use the word leverage, because in this context, leverage actually becomes debt. It gives you more power.
Negotiation, because if the bank already knows that you're able to go and to issue or make a bond issuance, they are going to give you better terms.
Okay, so maybe it'll bring down rates for both, but let's say, but after you've negotiated, is the bank loan rate going to always be higher, lower, or about the same as the corporate bond rate? If it's higher, it's a no-brainer. I always go with the corporate bond. But is it always going to be higher? What do banks have as an advantage that corporate bondholders don't? No, that's not bring that in. I don't even want to go there. Actually, corporate bondholders are more diversification than banks because you're a corporate bondholder, you can own hundreds of corporate bonds. You can actually argue you're more diversified.
Because if you're going to make corporate bond issuance, you have to pay a fee.
Because there's an issuance cost, but so there may be, but that's tiny. The issuance cost, especially corporate loans, like 0.1 or 0.2%. Have any of you taken a bank loan as a business? Has anybody taken a bank loan here? Have you taken a bank loan? So what happens? How do you just go to the bank and you say, I'd like to borrow money? They lend you the money. They will send somebody over to your business. They look at it. They can ask for information that is proprietary information because they're the bank lending money. So one of the advantages that banks have over corporate bonds is they can do a degree of due diligence with internal information that an outsider might not have. What I'm saying is, if corporate bonds were always cheaper than bank loans, you know what you should see, right? Every US company pretty much should have only corporate bonds, but even companies like Disney that have corporate bonds will also have bank loans. Partly because on some aspects of the business, especially the real estate aspects of the business, it might be cheaper to borrow from a bank than to borrow from on a corporate bond, because the bank can then secure the bond with a specific asset. They can do their due diligence. So it's not a slam dunk that corporate bonds are cheaper, but let's face it, having the choice of corporate bonds always makes your life easier as a company, even if you don't use them, because you can use it to get better terms on your bank loans. So let's look at the breakdown of bank loans versus corporate bonds in the companies that I'm going to be analyzing. So you remember, I have 4 publicly traded companies, Disney, Vale, Tata Motors, and Baidu, on which I can do that. What's a missing public company that you don't see there? Deutsche Bank is not there. I don't even want to open that can of worms because looking at debt in a bank is almost nightmarish. I'm not even going to try. So I'm going to focus on the 4 companies where debt is actually a source of capital rather than raw material. So this is something you can do with your company. You can take the existing debt, and if you go through the footnotes enough, you can break down how, the maturity of the debt. In this case, if you look at the breakdown of the debt first, I have a book value for each of these companies of debt and I have a market value. I don't want to pull a scab off, but if you don't know why there's a difference, you might want to revisit problem 1 in quiz 2 and then close it up very quickly because that's exactly what we did, right? So the market, notice that for all four companies, the market value of debt is slightly lower than the book value of debt. In some cases, a little bit more than others. If you look at the breakdown of debt, Disney has about 8% bank debt, 92% corporate bonds. That doesn't surprise me. US companies tend to have a higher reliance. But what is surprising is how much of Vale's and Tata Motors debt is now in the form of corporate bonds. 30 years ago, if you looked at those two companies, all of their debt would have been bank debt. You're starting to see the shift across the world of companies at least being able to access corporate debt or corporate bond, the corporate bond market. It's a good choice, as I said, for them to have. And if you look at Baidu, all of the debt is bank debt. So breakdown of the debt. Next, I looked at the breakdown of maturity of the debt. So I know it's tough to read this, but if you look at Disney's debt, about 49% of the debt is between 1 to 5 years. It's more medium-term debt, but there's one outlier. If you look at the very, very long-term debt, Disney actually has about 13% very long-term debt. So it has a lot of medium-term debt or shorter-term debt, and it has, does that make sense? It's a company, but it's in 5 different businesses. If I asked you to guess, which of those businesses have the really long-term debt? The parks probably have the longest term debt. You're borrowing against Disney World or Disneyland. It's really real estate you're borrowing against and really long-term real estate. So already I want you to start thinking about these companies as a collection of businesses because it's going to explain the maturity. And if it doesn't, you have to ask the question, maybe the company has the wrong kind of debt. Now, if you look at Vale, it has the highest average maturity of the debt of any of these companies. Makes sense, right? It's a mining company and it takes these really long-term projects. You would expect it to have much more long-term debt. If you look at Tata Motors, the debt is centered around the 5 to 10-year debt. My guess is a lot of that is the bank debt. And this is another reason you sometimes take bank debt, is you can issue corporate bonds with 30-year maturities and 50-year maturities. It's sometimes difficult to get bank debt with really long maturities because banks will not lend at that. So is this the right kind of debt for Tata Motors? We'll come back and examine whether the maturity is right, it's too long or too short, but it's centered around the 5 to 10 years. And if you look at Baidu, it has the shortest term debt of all 4 companies. Now, does that make sense? What business is it in? It's a technology company. And what's the nature of technology? Life cycles are shorter. You don't want to take a 30-year loan, even if you're making a lot of money on a technology, because who knows what this will look like. So already, at least at a surface level, it does make sense. Then I looked at how much of the debt is in the domestic currency, which for each company is different because, you know, for Disney, it's US dollars, for Vale, it's Brazilian reais. And if you look at Disney, they have about 95% of their debt in US dollar debt and 5% in foreign currency debt. Again, a very surface level question. Do they have, is that mix right for Disney? What's a very simple breakdown I can look at to make a judgment on whether this is the right mix of debt? Do you remember the breakdown? I did the equity risk premium for Disney. I broke down their revenues to US revenues and revenues from outside the US. I'm not going to ask you whether you remember the statistic, but it was 82% from the US, 18% from outside the US. I know it's very surface level, but they get 18% of the revenues from outside the US. They have only 5% of the debt, which is foreign currency debt. Maybe they have too little for, you're already I want you to start making judgments. Be judgmental when you do this. When you look
those 18% that go.
So that's why I said that's why I said it's surface level. You don't know whether we don't know also whether they're hedging some of that risk. You could borrow everything in US dollars and use derivatives to match the rest. So at least at the moment, it's a very surface level judgment. We need to dig a little deeper to see if in fact, if you look at Vale, 66% of their or 65% of their debt is foreign currency debt, almost all US dollars, 35% is in Brazilian reais. That sounds odd, right? It's a Brazilian company, but does that make sense for Vale though? It's not just that its revenues come from outside Brazil, but it's a commodity company. You're saying, so what? commodity kind of businesses still work in a dollar market, whether you're an oil company, a coal mining and from that perspective, it does make sense that the debt is dollar debt.
If I was Disney and I was investing in like maybe a theme park in Tokyo, why would it make sense for me to take in dollars versus?
That's why I said at the moment, at least it doesn't make sense. But remember, here's my counter. I could borrow in dollars, but I can fix the foreign exchange mismatch by using forwards and options. That's why until we look at what else Disney is doing, it's too early to pass the judgment. It's a surface level judgment, but you're right. It doesn't look like it matches, but maybe they have a good explanation for why. And finally, if you look at Baidu, 82% of the debt is in foreign currencies. Does that make sense? I haven't looked at Tata Motors, I'll come back. What do? Their search engine in China, I can guarantee almost every unit that they make is in renminbi. It doesn't make any sense. So this looks like a serious mismatch. And we'll have to come back and say, why might a company that gets all of its revenues in the local currency borrow outside the market? Okay.
Incorporated outside of.
But even then, it wouldn't make sense, right? Incorporated outside China doesn't mean you need to borrow outside China. You'd still want to borrow in currencies that match your revenues because you have to make your interest payments out of it.
Okay.
You can't make it out of the Cayman Islands. They have nothing in the Cayman Islands, right?
Chinese banks
You're looking for a rational explanation for companies sometimes doing stupid things. It's good to do that, right? Sometimes you say, oh, it must be this, it must be that. But let's face it, there's often another reason, which is, remember when we talked about interest rates and we talked about comparing Celsius to Fahrenheit? That it always feels cooler in Celsius because the numbers are lower. But it isn't, right? If it's 85 degrees outside in Fahrenheit, it's still 85 degrees. Once you convert it into Celsius and say it's 26 degrees Celsius. What I'm trying to say is sometimes companies do stupid things. Leave open that possibility and don't try to explain. But I think I think what you're doing is the sensible thing to do. Maybe there's a good reason, but after you go through reason 1, reason 2, reason 3, reason 4, it's not there, not there, not there, not there. By the time you get to the 7 3s and you got to say, these managers are just in denial. They're just making dumb decisions. It's going to come back to bite them. And finally, I also looked at and for Tata Motors, notice about 29% of their debt is now foreign currency debt. It actually has gone up even more. It's now closer to 40%. Why? What did Tata Motors do in 2009? They bought Jaguar Land Rover. And over the last 13 years, Jaguar Land Rover has grown faster than their mass market domestic, the Indian company. So that, again, at least it's a surface level judgment. And then finally, I looked at the percentage of debt that's fixed rate and floating rate debt. Now, before I look at the percentages, everybody know how first, you know how fixed rate debt works, right? You go in, you borrow money, the rate is set for the next 10 years. How does floating rate debt work? What's the mechanism? Dor, what do you do with floating rate debt? Okay. Go ahead. It has to be set to something, right? LIBOR or a prime. There's a base rate that's specified up front. And every period, as that rate changes, your coupon rate or interest rate will change as well. Now, if I asked you which is better, fixed rate or floating rate debt, I don't want to give you an answer yet because obviously one can't be a slam dunk over the other. Everybody will be going with that kind of debt. So we'll come back and talk about why some companies are better off with fixed rate debt and others with floating rate debt. But you look at across these companies, very little of their debt is floating rate debt. Almost all of it is fixed rate. So what I'd like you to do is, for the moment, chronicle what your company is using. Pass an initial judgment, and later on we'll come back and ask the question, maybe this company has mismatched its debt. What can I do to fix it? Because the advantage of being in 2023 as opposed to 1973. In 1973, if you had debt that was mismatched, you know what you had to do? You had to pay off all that debt and replace it with new debt that matched what you needed. Today, we have swaps and derivatives and tools we can use to fix the mismatch. But you need to find the mismatches first. So let's get this process rolling and think about why some companies are better off borrowing money and others are not. Let me go back to that corporate life cycle that I've used before. You know, company, it's a startup, it's a young growth company, high growth company, mature growth, all the way to decline. If you're a startup and you think about how much should I borrow, you're thinking about the wrong thing. Why even asking this question? What should you be asking as a startup? What's my business? How do I build a market? How do I make money? It doesn't make any sense for you to borrow money. Why?
They won't borrow, they won't lend.
There are people who will lend you money, right? There, Silicon Valley Bank is lending you venture debt. What is the venture debt? It's debt for young startups. It's a stupid idea to begin with. Why? Because what do you need to? So what's driving your value? Hope and expectations, right? Try making debt payments with hope and expectations. Walk into a bank and say, I have a lot of hope. Will you take that instead? No, it doesn't work. You don't have the cash flows to service the debt. This is not some elaborate theory. And borrowing money puts what at risk? That dream that you have that might actually be a really good business, you're putting it all at risk for why? An interest tax saving you can't get because you have no taxable income. There's no conceivable reason for borrowing money. You think, why would they do it? Venture debt is really bridge financing. It's to get you from one VC round to the next VC round. It's dangerous because if the next VC round doesn't show up as expected, all this entire house of cards comes down. But if you think about it from a pure perspective of, is this good for my business? Startups should have no debt at all. Young growth companies, what do they have? They're starting to get revenues, but they're still losing money. And what do they need to do to get the growth? They need to reinvest. Their cash flows are big negative numbers. First rule in your hole is stop digging. So your cash flows are already negative. Why would you want to add to it by borrowing money? So young growth companies shouldn't borrow money. Then you get to be a growth company. Now your profits are starting to show up. You're still reinvesting. And remember, your income turns positive before your cash flows turn positive because you're still reinvesting. Your cash flows could be negative. So you're a high growth company. I can see why you don't want to borrow money. But eventually what happens to high growth? It starts to level off. Why? Because you get to be too big to grow at 15, 20, 25%. So your profits are now becoming much more substantial. You don't have as much in reinvestment needs. Guess what? Your capacity to borrow money just opened up. So do companies jump at that possibility right away and borrow money? When you get to be 35, you're really middle-aged, right? But every day you look in the mirror and what do you tell yourself? I'm really 23 years old. I can do things I did 10 years ago. Denial runs deep, right? Nobody wants to get old. So guess what these companies do? Oh, we're going to go back to being growth companies. We're just having a bad year, a bad 3 years, a bad 5 years, a bad decade. And after a while, you realize this is not just a bad period. This is who we are. We're aging. It took Intel 9 years after it became a mature company to accept the fact it was a mature company. So what happens in that period? You're maturing, your cash flows are coming in, you're refusing to borrow money, your debt ratios stay low until somebody prods you and say, guys, you could borrow money. That's what Apple got as a reminder in 2011 from Carl Icahn. He said, you're generating billions of dollars in earnings, you're giving up tax savings, but you almost need an external force coming and saying, you can borrow money. Eventually they wake up, they borrow money. And as they get to be mature companies, you'll see debt ratios kind of level off. You're at a debt ratio you can sustain. Then you go into decline. What's the nature of decline? Your company starts to shrink. So even if your debt ratio stays the same, what has to happen as your company shrinks? You should be retiring debt, because if you don't retire debt, you leave it at where it is and your company shrinks. It's almost like you can see what the end game is going to be, right? At some point, the value of the company is going to go below your debt. The whole thing blows up. You tell me where your company is in the life cycle. I can guess how much debt it should have. Then you can actually look at the debt and say, hey, that doesn't make sense, or that does make sense. A mature company with no debt doesn't make sense. You have to say, what's going on? And we can talk about the behavioral forces or the control issues that might keep the debt ratios up. A young growth company that has a lot of debt, something's off. Mismatches are what you're looking for, saying something needs to be fixed. So let's talk about the transitions here, right? You have you have startups. To become young growth businesses, they need to go through a transition of an idea becoming a product. Remember, most ideas, what happens? They stay ideas, they crash and burn, a few $1 million, a few $100 million gets burnt up. But that's a first transition. You now have a business. You're not making money, but you have a product you're building up. You build up the business. And initially, what do people focus on? They focus on growth. Number of users, that's great, build up users. Not because they're being unrealistic, but right now you don't have income. I don't expect you to yet. So I let you go along on your user chase, your customer chase. You show me revenue growth numbers and I keep rewarding you. And then some companies fall into the trap of thinking this is all I need to do. I just keep building up my user base and pushing up revenue growth. My market cap will keep going up. And then a transition hits that I call the bar mitzvah moment for companies. For those of you Jewish, you know that bar mitzvah is when you're told you are a grown-up. You're already 14 years old, but you're not quite ready to grow up. But you say, you know what? You're into this. You don't want to be grown up yet, but no, the bar mitzvah moment for companies is when the market says, you know what, guys? You're not making money. Your reaction is, you expect us to make money? Nobody told us this. That's when you failed your bar mitzvah moment. You know it's coming, so you know what you need to do as a young growth company. You need to be prepared for that moment. So while you're working on one channel, delivering users and delivering revenue growth, on another channel, somebody needs to be working on a business model that converts those users. You think that's obvious, everybody should do. We spent a decade encouraging companies to scale up and not think about business models. I remember the day in 2019 when Dara Kostrowski said, you know what, Uber needs to make money. And I got down on my knees, I looked up and said, thank you, God. Finally, they've come to that recognition. This is 10 years after what? How many billions of dollars in venture capital money? Don't assume again that people do this. So when you look at a young growth company, you're looking at their growth potential, but you're also looking at the management asking, does this management recognize that they need to be building a business model in parallel? So when the bar mitzvah moment comes, and if you think about transitions in the capital market, young startups are almost always privately owned. But when you're privately owned and you're the owner, you have a serious problem, right? Which is you have a wealth constraint. So if you want to grow your business, you have to go seek capital. So in terms of capital transitions, as companies grow, first you tap out your family, but then they refuse to take your calls. They shut the door on you because they're tired of putting money into your business, or they don't have the money to begin with. But if you have a promising company, what do? You go to venture capitalists. Now, venture capitalists have been around as venture capitalists only for about 70 years. I think the birth of the VC business, as we know it, in the 1950s in the US. But venture capitalists have been around forever, even though they haven't called people who supply capital. They're saying those people must be such amazing people, such Mother Teresa's of the capital market. But if you're the venture capitalist, in return for supplying capital to young startups, what do you get in return? A disproportionate share of the equity. Let's be quite clear, right? A disproportionate share of the equity. And they're doing it saying, look, if I'm not here, you're going to be nothing. There's this, in venture capital, there are two values for a company, a pre-money value and a post-money value. Pre-money value is, if I'm not around, this is how much you're worth. Post-money value is, if I give you the money, this is how much you're worth. And every venture capitalist, if you let them set the terms, will say, your pre-money value is 0. Without me, you're nothing. With me, you are $1 billion. And because it's all me, I should get 100%. They don't quite get 100%, but you can see the negotiating play out, right? What I'm saying is there is this trade-off you have to do. You have to grow as a young startup. You get venture capital money. It's good because you can now grow, but you're giving up a disproportionate share of the ownership. So people who are casual about raising venture capital, you got to ask the question, have you thought through what this means for what your ownership stake in the business is? Because you might end up going public owning none of the business because you've given it away in 17 rounds of venture capital. If you get a chance, there's this database called Crunchbase. You don't have to be a subscriber. You can get on, pick any young company going public. You can see the history of VC rounds that they've gone through. It's very telling how much capital has been raised before they go public. So that's the first transition. To use venture capital money, you grow. Eventually, you get sick and tired of giving up huge chunks of your business in return for venture capital and negotiating with them. So at some point, what's the second transition? You decide to go public. Because you're now negotiating with diversified investors who basically will not, it's not that they don't want money in return, but they're not getting a disproportionate amount. Is there a trade-off there as well? What are the costs of going from being a private company that's entirely VC-based to a public company? First is there's a board of directors even for private companies, but now the board of directors is elected by the so instead of having a board that the VCs might be putting together with you, I'm not sure one is different. They're both different. You could actually argue that a board picked by shareholders is more likely to be a rubber stamp board than a board picked by VC. So I'm not sure that's a bad thing. But being public also comes with disclosure requirements, right? It comes with having to deal with equity research analysts. It comes with the earnings calls. It comes with restrictions on insider trading. And those can be a factor in going, but 30 years ago, there's a point you had to go public because there's only so big you could get with venture capital, maybe $1 billion, $2 billion. After that, you were too big. And then in the last 20 years, a gray market developed where private companies could stay private much longer and raise a lot more capital. Uber was a private company when it raised money from the Saudi investment fund to get to a $65 billion valuation. There's zero chance in the 1980s you could have become a $65 billion company. So what do you think contributed to the growth of the gray market? How do these private companies now get access to all that capital? Who invested in Uber besides the Saudi investment fund? Fidelity did. T. Rowe Price did. See what's happening. Public market investors were now invested. And in a sense, you get to have your cake and eat it too, right? As a private business, you're raising money now from public market investors. You have none of the disclosure requirements that you have as a public company. It's a very dangerous space to be if you're Fidelity. I remember when Fidelity made that investment, I said, this makes no sense. You have none of the due diligence components you need for an investment, but you're investing $2 billion in a company. But you know why they did it, right? FOMO. Everybody else is making so much money. It's greed. Let's face it. It's greed that drove public markets here. And it's created this new environment where companies going public can now go public with a $100 billion market cap. If you get a chance, go back and look at what Apple's market cap was when it went public, Microsoft's market cap when it was public. And then look at the market caps of companies that were public in the last decade. But in each transition, you're making these adjustments. So now you're a public company, you made the transition. Can you go raise capital? Yes, you can make what are called seasoned offerings. Seasoned offerings are public companies that are already public issuing fresh equity. Here the trade-off becomes when you issue shares. That word that no investment banker or CFO likes to use pops to the surface, right? What do people talk about when you issue shares? What's a word that stops them? There will be dilution. And that's like garlic with a vampire. You say the word dilution to a CFO, say, oh, I'm not issuing shares, that's dilution. We'll talk about the stupidity of not issuing equity because of dilution. But a lot of companies, that stops them from. So if you take that process in, let's talk about making the first stop. So you've looked at your company's debt, made the right categorization, you look at its equity, and you got to compute how much debt does my company have right now. Now you could give it in dollar terms, but it's kind of meaningless, right? Because so if you say I have $30 billion in debt, that could be a lot of debt if you're a $40 billion company, but it's almost no debt if you're a $1 trillion company. So we specify debt as ratios. And we've already used these, right? Debt to equity ratios, lever betas, debt to capital ratios. But I want to step back and think about the variance you're going to run into. First, you can have debt to equity or debt to capital. Remember, if I give you one, you can always compute the other, right? So if I say your debt to equity ratio is 100%, Tariq, how much is my debt to capital ratio if my debt to equity ratio is 100%? So for every dollar of debt, I have a dollar of equity, right? 50%. So if I give you one, you can always get the other, because all you need to do is make it if nothing else, make it $100 value and say, if I have this much debt and this much equity, but I can compute debt to equity and debt to capital ratios using book values or market values. Can the numbers be different? Again, I don't want to rip off a scab, but I will. But if you take problem 1 and quiz 2 and work out the cost of capital with book debt ratios, you get a very different cost of capital than with market debt ratios. So you can have book value or market value. Which one do you think when you look at services reporting debt ratios? So you look at value line, you look at S&P, and they report a debt ratio. Which one do you think is the default? Book value debt ratios or market value? It's almost always book value. So the next time you see a debt ratio in Yahoo, and it's very different than the debt ratio you computed for your company, it's because it's a book value debt ratio rather than a market debt ratio. So you have book versus market. I've seen investment bankers who compute only long-term debt ratios. Don't ask me why, but when you ask them what's the debt ratio, they use only long-term debt. And now that leases are debt, I've seen analysts report debt ratios with leases. It's almost like they want to reverse the process and go back to the old days. But all I'm saying is be careful. When you say debt ratio and I say debt ratio, we might mean very different things. And since what I say matters more on quizzes, I'll tell you what I mean when I say debt ratios. There's no confusion. When I say debt ratio, I always mean debt to capital. Because if I want to say debt to equity, I will say debt to equity. So debt ratios to me are debt to capital. And I always use market value, not book value. And I always use total debt, including leases. So at least you know where I'm coming from. But my advice to you is when you're talking to people about debt ratios, put them on the spot and ask them to define what they mean by debt ratio. Otherwise, you could be talking about two different things for the next 30 minutes or 45 minutes or an hour. So let's talk about the basic question we're going to try to answer. So you have a company, the question you're asking is, I have two choices. I can either borrow money or use equity. Forget about hybrids for the moment, debt or equity. Which one is better for me? What are the trade-offs involved? So I'm going to first start about what I call the illusory trade-offs, things that people use as reasons for borrowing money or not borrowing money, and dismiss them, and then talk about the real trade-off between debt and equity. So let's talk about the illusory trade-offs. And these, I mean, you'd be surprised how many companies give these reasons for either borrowing money or not borrowing money. Let's look at two illusory reasons given for borrowing money. The first is that it's cheaper. Debt is cheaper than equity, is it? No. In what ways is it cheaper? What was my cost of equity for Disney? It's an unfair question. It's like 3.5% with the single A rating. What was my cost of equity? Cost of debt was 3%. My cost of equity was 9%. And I'll wager when you do this for your companies, and hopefully it'll be soon because your project is due May 8th, you will find the same thing for every one of your companies. I guarantee your cost of equity is higher than the cost of debt. So that seems right? Debt is cheaper than equity. It'll always be cheaper than equity, no matter how much you borrow. Why? It's because equity is the last guy in line. So the guy before him is charging 20%. And you're the equity investor, guess what? You need to be charging 20% plus. It makes no sense to be the last person in line. So it's an absurd argument, because if I carry this through, I should be 99.99% debt, because debt will always look cheaper than equity. We'll talk about why it's an illusion. later in the process when we talk about bringing equity in. It just looks cheap. I'll give you what real estate developers use as the reason for borrowing money. Because real estate debt is used extensively. They'll say our return on equity will be higher if we use more debt. Technically, that's absolutely true, right? You take a real estate building that has a 9% return, you borrow money at 5 or 6%. The difference goes to equity investors. And the more you borrow, the more you can push up your return on equity. This is good, right? But when I ask, is the return on equity high enough? What do I need to compare it to in finance to make that judgment? What do I compare return on equity to? Not the credit rating. The return on equity has to be compared to the, and which hurdle rate? Cost of equity, right? So when I borrow money, my return on equity goes up. Remind me again how I compute cost of equity. I take a risk-free rate and equity risk premium, right? Neither of those is affected by debt, but I multiply the equity risk premium by a beta. And what is that beta driven by? What business I'm in and how much my debt to equity ratio is. You see why this is an illusion. I have a higher return on equity, but guess what's happening to my cost of equity as well? It's also going up. So if the reason you're borrowing money is to push up your return on equity, for God's sake, stop. Because your cost of equity is also driven by the same forces. If you start out with return on equity equal to cost of equity with no debt, guess what it's going to be after you borrow 100 billion, 200. It's going to kind of keep up with it. If you start with the return equity higher than the cost of equity, you might be leveraging it up, but that leverage effect, if you take the present value, is now going to be discounted at a much higher cost of equity. So
the same as what hedge funds do when they leverage.
If that's what they do, stay away from them, right? Hedge funds actually don't borrow money. They take positions on both sides of the market. That's what a classic hedge fund is. Some of them play games. They use leverage. Those are the hedge funds you want to avoid, because if the leverage is what you claim makes you a hedge fund, you're missing the point of being a hedge fund. One of the big advantages of being a hedge fund is you can sell short and overvalued securities. You can go long and undervalued securities. And you do it right, you take advantage of corrections in both directions. But what you're pointing out is out of every 100 hedge funds, maybe 5 are truly hedge funds. The rest are just playing games with levered equity, right? And that's not a game you're going to win over time, because the leverage is going to blow up sooner or later. Now let's look at 2 reasons companies give for not borrowing money. There are some companies that refuse to borrow money. One is, if we borrow money, our net income will get lower. Will it? Absolutely, right? Why? You have interest expenses. That's bad, right? Lower net income. But what are they not bringing into account? It's true net income will be lower, but if you borrowed a lot of money to fund the business, you also have fewer shares outstanding. You have less equity. That's why we look at per share earnings rather. So the reason you're not borrowing money is my net income will be lower. You're failing to factor that you'll have far less equity at play, which will give you potentially a much better return. The other reason I've heard CFOs give is, if I borrow money, my rating might suffer. Will it? Probably. So what? Would you rather be a AAA rated company that never borrows money, or a AA rated company that borrows money? Remember, the AA rating gives you a lower cost debt, but how did you get the AAA rating? By never borrowing money. This is not about what the cost of debt was at a AAA or a AA rating. It's what you're replacing with that AA rated loan, which was equity. I'd rather you consider the trade-off. I'm not asking you to lower ratings and just make that your end game, but I'm saying if you borrow money and you're able to replace expensive equity with cheaper debt, I can live with a slightly lower rate. Of course, I'll put a floor on it. So these are the reasons you're not borrowing money. They're very surface level reasons. But again, a lot of companies, we look at why they borrow money or why they don't. Those are the reasons they give you. So let's look at the real trade-off that should animate the choice between debt and equity. There are 2 benefits that come with debt. The biggest, by far, is the tax benefit. I'll make a statement up front. If tomorrow the tax code were fixed, and it can be fixed in one of 2 ways. Either you can make interest expenses non-tax deductible, which will probably cause bankruptcies all over the place, or what's the other alternative? What's the problem right now? Interest expenses are tax deductible, but cash flows to equity are not. So either fix one side or the other, but if you did that, I will, and this is an assertion I make, your biggest reason for borrowing money is gone. In fact, it might take away the entire reason for borrowing money. So the next time you see a politician get up and say, hey, companies are borrowing too much money, this is terrible. Ask them a question. Who wrote the damn tax code? I didn't write it in my basement. You guys gather together, you call yourself the legislature, you wrote a tax code that rewards the borrowing money, and then you moan about the fact that people are borrowing money. Either fix the tax code or stop moaning. You can't do both. Tax benefits of that. So we'll talk about why those tax benefits can vary across companies within a market, and why the tax benefits can vary across geographies. Why a company in Ireland will borrow less money than a company in Germany. And you can already see the seeds of that argument come to the tax benefits. The second argument is a little subtle. It's really an argument that applies to older, more mature companies, which are publicly traded and widely held. You know what I mean by widely held? Their shareholder base is very dispersed. And they're being run by managers who are casual and lazy and set in their ways. And they have a big buffer, right? What's a buffer? They're making a lot of money. And borrowing money makes your life more difficult as a manager. Why go looking for trouble? And because you're casual, you sometimes take bad projects and nobody notices. You're Coca-Cola. You take a bad project, you're making a lot of money, you cover it up. New Coke, old Coke, just cover it up. Somebody writes a case about it, but it doesn't affect you. You know what? Sometimes with companies like that, borrowing money can make the company more disciplined in its project choice. I'll come flesh out the reason for that. But there are some companies where the argument for borrowing money comes from, hey, we need to make these managers more disciplined in their project choice. Two big benefits, that's it. There are no other benefits to debt. And people make up benefits, dig a little deeper, and they disappear. It's got to be weighed off against three costs. The first is the obvious one. When you borrow money, it might be cheaper than equity, but because it comes with contractual claims that have to be met, failing to make those claims can create bankruptcy and its associated costs. So I'm going to flesh out what those costs are and why they might be greater for some companies than others. The second is when you borrow money, you're introducing a new claim holder into the business, right? With a very different set of interests than the existing claim holder. You're the equity investor, you have one set of interests in the company. Now you introduced a bank, which has a very different set of interests. That's called an agency cost. We'll talk about the consequences of that and how you as a company end up paying for that agency cost and why it varies across companies. And finally, remember the old saying, it's nice to set aside money for a rainy day. Let's say you can afford to borrow money now and you borrow the money. And a recession, or this big project you have to take, and you've used up your debt capacity. It's a problem, right? So the third factor I'm going to introduce is how much do you as a company value the flexibility of being able to borrow money because you have the capacity to do something you don't see right now coming up, but might show up. So let's start with the first of these benefits. And by far, to me, this is the biggest benefit, the tax benefit of debt. Now, the simplest way to see the tax benefit, look at the interest expenses, lowers your taxable income, and it saves you taxes. And if you think about doing this every year that you have the debt, you can compute the present value of those tax savings. And in fact, one very simplistic computation of that is to take your total debt and you multiply by the tax rate, you get a rough measure of this is how much I will save as taxes on this debt in perpetuity. But you know what drives your tax benefit, right? It's your tax rate. And remember, we talked about tax rates. There's an effective tax rate and a marginal tax rate. And you got to ask yourself, which one applies on debt? And because debt saves you taxes, the margin, the argument, it has to be the marginal tax rate. So you could have a company with a 10% effective tax rate and a 25% marginal tax rate, but it'll place its debt in a way in which it gets a 25% tax benefit. You see this with Apple, right? Its tax rate is low because it has global income. And it gets a weighted average of those tax rates, but its debt is all in the US because it wants to get the 25% tax benefit. So the tax rate becomes the key player. So other things remaining equal, The higher the marginal tax rate you face as a company, holding all its constant, the more debt you can afford to have. So let's think about, you can see why marginal tax rates vary across countries. But if you think about within a market, you might say, why would tax rates vary across companies? They're all, so let's take the US. The marginal tax rate in the US right now is 21% of the federal level, plus state and local taxes gets to 24, 25, maybe even 26%. So you think every US company faces that marginal tax rate. First, even among the 7,500 US companies, which companies don't get any tax benefit from debt? The 3,000 companies that are money-losing companies right now, basically. And in fact, it's not just money losing. If you have NOLs and other stuff carried forward, you can effectively be not paying taxes the next 5 years, which means you really get no tax benefit from debt while that NOLs are. But let's take one very specific sector where you actually have multiple ways in which you can create companies. And let's think about how marginal tax rates play. Let's take real estate. You enter the real estate business, you can enter it as a corporation, traditional company, you have taxable income, you get taxed. You can also create what are called real estate investment trusts, created by a special law in Congress in the early 1970s. And REITs, as they're called, basically can invest. First, they come with restrictions on what you can invest in. You can invest only in real estate. You can't go diversify into software and other stuff. It has to be only real estate. But they come with a sweetener, which is if you run a REIT, what is the tax rate that you pay on your taxable income? 0. Seems like an amazing plus, right? There's nothing the government ever gives you without a catch. So in return for having a 0 tax rate, what are REITs required to do?
They have to distribute 85%.
They have to distribute as 85, 95, the bulk of their income has to be paid out in dividends. You see how the IRS gets you one way or the other, right? So those dividends land up in your mailbox or digitally in your bank account. The IRS knows. Don't assume they don't. I read taxes, they do track. You have to pay taxes. So their view is we're going to get your taxes one way or the other. Yeah. But let's focus on REITs versus real estate corporations. Real estate corporations have a higher, clearly, pay the 25% tax rate. REITs face a 0% tax rate. If you compare the debt ratios of REITs to real estate companies, you can already see which one should have the lower debt ratios, right? REITs should have the lower debt ratios. Now you can check whether that's empirically true. And there are some REITs with high debt ratios. And as I said, don't look for rational explanations when stupidity might explain the whole thing. But REITs left to their own device, if you look at the tax benefit, should borrow very little money. You know, the other group of companies that has very low marginal tax rates? Cruise lines. Now, usually, if you're a foreign company and you sell stuff in the US, you get taxed because you get taxed not based on where you're incorporated, but on where. So if you're a company in Liberia and you make cars and you sell them in the US, you get taxed because it is being sold in the US. So you say, what makes cruise lines different? You know, a lot of cruise lines are Liberia-based or Panama-based, right? But they still get 80% of the revenues from people in the US taking cruises. Have you ever taken a cruise? I've taken one. Never again in my life will I get on that. It's a monstrosity. All you do is eat, eat, and eat. I don't think there's anything else to do but eat. And if it's gambling, it gets even worse. You eat, you drink, you gamble, and you come off the cruise, with half the wealth you had when you went in. But there's this very strange phenomenon. They get you on, there's a little song and dance, you get on, and then you sit and wait for a drink to be served to you. And it takes about 30 minutes after the cruise ship leaves the port for things to start showing up, for the guy with the credit cards to come around and charge you stuff. You know why? Because you're now outside the 15-mile zone or 20 miles. You're in international waters. Basically say, you can't tax me. I'm in the middle of the Pacific or the Atlantic. So if you look at, if any of you are looking at cruise line companies, you look at their tax rates are tiny, 3, 4, 5. Of course, right now they're all losing money. It's not even an issue. But even when they were making money, they had these And in a sense, that's also their marginal tax rate. So what should cruise line companies then use to fund their businesses? Primarily equity. The only problem is their big investments are all these cruise ships. And they often borrow the money to buy the cruise ship, but they know that the debt is not getting them a benefit. They try to pay it down as soon as they get. So it's almost like they go through these cycles of borrowing money. Oh my God, what did I do? I'll pay down the money, I'll borrow the money again, pay down the money. But from the perspective of creating value, it doesn't make any sense for a cruise line company to borrow money.
Why do they do it? Because it's hard.
Because they don't, it's good. I mean, if you think about it, why don't they issue, what's the other alternative to buy these cruise ships? What could they do? Issue equity, right? And if you issue shares, there's a control issue, you're Liberia based, who knows where your corporate governance structure looks like. In fact, I'll make this upfront. A lot of companies borrow money because they put control ahead of value creation. Middle East, if you're a Saudi Arabian company or a company in the UAE, you should not be borrowing money. You know why? It's a one part of the world we actually don't get tax benefits for debt because of religious reasons. A lot of the Middle Eastern countries, if you have interest expenses, of course, companies have learned to play the game. You call it something else, it's interest expense masquerading as something else. But from a perspective of borrowing money, if your tax benefits are zero, you shouldn't borrow money. There, of course, it's a combination of control because many of these Middle Eastern companies are family controlled. And the fact that your equity markets are so underdeveloped that you're worried about going out and trying to raise equity. But what I'm trying to say there is they're not doing the right thing, but they're being constrained by frictions to do the wrong thing. Now let's focus in on this marginal tax rate issue. Until 2017, in fact, I wrote a piece in 2003 where I described the US tax code as the most dysfunctional tax code in the world. It had two features that made it dysfunctional. One was a marginal tax rate of 40%, which at that time was the highest marginal tax rate of any major, economy in the world, highest marginal tax rate. And they also had this practice where they tax all of your income. If you're a multinational company, all of your income, no matter where you made it in the world, was taxed at the US tax rate. I'll come in and tell what there was a qualifier when it got taxed, but it got taxed the US tax rate. It made it one of 6 countries in the world, which had that, because every other country you were taxed based on, so if you're a UK company, you were taxed on the UK tax rate on your UK income, but if you made income in Hong Kong, you paid the Hong Kong tax rate and you were done. But the US, if you made money in Hong Kong at a 15% tax rate, they taxed you at 40%, but the qualifier was only when the money came back to the US. You got to wonder who writes these tax laws. Because you know what companies did, right? They didn't bring it back. It was called trap cash. I remember people saying, where is it trapped in? Who traps it? At its peak, there were $2.5 trillion in trap cash. I think at one point, Apple alone had $140 billion in cash trapped overseas. Trapped because the minute you brought it back to the US, you'd have to pay another 18%. So the 2017 tax law, and this is the good part of the law, it came with a lot of qualifiers. First is it brought the marginal tax rate down to 21%, which would state and local taxes put them around 25%, which put the US marginal tax rate at very close to a global marginal tax rate. So in Europe, the average marginal tax rate is like 26%. And the rationale was we want to take away the reason why you're keeping your income. And the second thing that changed was they decided to shift away from the global taxes, the US, where everything gets taxed, the US taxes, to the system that the rest of the world was following. But cutting a long story short, you've taken a 40% marginal tax rate, you've made it a 25% marginal tax rate. This is a momentous shift, right? So this happened in 2017. So in 2018, I went and looked at the debt at US companies. 2019, I looked at the debt again. And what was I looking for? If the marginal tax rate goes from 40 to 21%, are companies behaving the way you'd expect them? And what did you expect companies to do now that the tax benefits of debt have become much lower? Borrow less. And they are borrowing less, but the change is like glacial. It's small. It happens. You're saying why? Inertia. Some companies, how you set things to on an autopilot on your phone, wake me up at 7 a.m. every morning because I'm too lazy to set the alarm myself. Some companies, I think, have an auto borrow. Just go to the bank every year, borrow 2 billion. Why? It's always done. Just a reminder, go borrow 2 billion January 15th every year. And they forget to turn that reminder off. And they keep doing this because that's what they've always done.
But also taking time, the percentages you showed before for 1 to 5 years and 5 to 10 years and all that.
And I'll give them one more good reason. Does the US tax code ever stay done? Every tax reform, what are we told? This is it. We fixed the thing. We will never come back to this again. We know it's a complete lie, right? Because 4 years later, oh my God, I think we need to redo the whole thing from scratch. So one thing that companies might be waiting for is, how do we know this will last? Maybe Bernie Sanders will be the next president and the marginal tax rate could become 95%. It's one of the advantages of living in a dictatorship, right? I'm not suggesting we all move to a dictatorship. At least the tax rates maybe stay what the government says they will for the near term or the long term. But it is, in fact, something to think about. The marginal tax rate, what's changing the market. So every time there's a tax reform act, I hold my breath because the entire trade-off could change as a result. The other thing that the 2017 tax code also introduced was until 2017, you could deduct interest expenses all the way up to your taxable income. 2017 tax code also put I think your interest expenses couldn't exceed 40% of your EBITDA. I don't know who makes up the 40% or what they came up with, but they've introduced a cap on tax benefits and interest expenses. So from both perspectives, you should expect to see less debt. Is it happening? It's happening, but it's happening very gradually. And maybe you need a shock to the system for it to happen more significantly. So a recession might be the test of what happens during the next recession, or higher interest rates, right? That's a reminder, hey, I have a lot of debt. Maybe I don't get enough benefits from the debt and I need to rethink this equation. So let's look at the second reason for borrowing money. I call this the Volvo argument for debt. Strange word to use, but I'll tell you why you call it the Volvo argument for debt. Let's say it's 5 years out, you've joined Goldman Sachs or KKR or DE Shaw, you've risen up there. Pick your optimal employer. You moved up the ranks. You moved to the suburbs. You have a big house, 2 cars, 2 spouses, whatever makes you happy. Right? And you don't, you'd get a limo to pick you up, but it takes so much time. You take the train into work. So here are your 2 cars. Your first car is a Volvo Extra Armored. It's like driving a tank around town, right? Side airbags, front airbags, back airbags, top airbags, bottom airbags, airbags all over, fully protected. There's a reason I'm putting that in the story. Your second car is some kind of a tin trap. I don't want to insult any of you with your cars. So I'll pick a car that none of you have. So Yugo or Trabant. Trabant are these German cars that would shake as they drove by. I remember that car is shaking on the highway because at some speed, I think the whole car would come apart. Okay? So it's the first day, it's your lucky day. You get to drive the Volvo to the train station. You drive in at 6 a.m. You park your car in the lot. You get on the train. You go to work. You work all day. You work all evening. You work late into the night. That's how you can afford the big house and the 2 cars and the 2 spouses. 10 p.m. you get off the train. You're exhausted. You crawl to your car. You can't even walk anymore. You get in your car. You live only 5 minutes from the train station, but between your house and the train station is a traffic light. So it's 12:05 or 10:05. You pull up to the traffic light. And just as you pull up, the light turns red. You say, oh, drat. Those are not the words you would use, but I'm censoring the language you would actually use. And as you sit there watching the red light, illegal thoughts start to cross your mind. It's the suburbs. There's nobody around. There are 2 things you worry about, right? One is the police, but these are the suburbs. They all go home at 7 p.m. There's nobody. You're not going to get a ticket. There are no cameras set up. The other is getting hit. Initially that stops you, but you remember you're in your Volvo extra armored. Somebody hits you, you get a little dent on the side. The other guy's all crumpled up. You don't care. You run through the red light. You get home, you go to sleep. You repeat the process the next day, but now you're in your little Yugo. You chug to the train station, you park, you get off at 10 p.m., you get in the car, you pull up to the top of the hill, and the light turns red again. It's like a conspiracy. You think about running the red light like you did yesterday, but then you remind yourself, I'm not in my Volvo. What am I thinking? A bicyclist comes along and hits me. I could roll off the road. And you stop. You're saying, what's this got to do with debt and equity and companies? Let's assume you're the manager of a company with lots of cushions. You're a money-making company, a very little debt. The red light is a bad project. You know you should be taking it, but you're lazy and sloppy. You run the red light. It's going to happen anyway. You lose a few $100 million, but you make so many billions elsewhere, you cover up your losses. Think of the same company stripped of its debt and its cash cushions, and you as the manager of that company, and the red light is about. What will happen if you take the bad project now? You could go bankrupt. And what will happen if you go bankrupt? You could lose your job. I'm making this personal because until I make it personal, you don't seem to care. It's an extreme argument for debt, right? Because I'm asking you to borrow money because I want you to be disciplined in how you pick projects. It's called the Jensen free cash flow argument for debt. Remember Jensen's alpha? It's the same Jensen. He likes attaching his name to whatever he does, so he's remembered in perpetuity. But I want you to put this argument to use because if this is the argument for borrowing money, I want you to think about what kinds of companies should borrow the most money. So I'll give you 3 groups of companies and you tell me which of these should have the most debt based purely on this argument. Should it be? So all these companies have very little debt. That's what I mean by conservative finance. The first company, though, is a privately owned business. Can I make the argument that you need to borrow money to make yourself more disciplined? If I do, you're in big trouble. It's your money. If you're not being disciplined, borrowing money is not going to make you more disciplined. So with privately owned companies, borrowing money to make yourself more disciplined suggests there's a deeper problem here that needs to be fixed. So it doesn't make sense. What if you take the other two? They're publicly traded, but one is a publicly traded company with a dispersed shareholding where nobody has an incentive to make an issue because they own so little of the stock, they just sell and move on. And the other is a publicly traded company with an activist investor or investors in its base. At least purely on this argument, you'd expect B to borrow more money because somebody looking over your shoulders, making sure you're picking the right projects, you don't need the discipline of debt. So do some companies borrow money? Yes, if you're mature companies, your dispersed holdings, your management has very little equity in the company. This was the argument that Mike Jensen used in the 1980s for the first LBOs that came about. He said they're happening at companies where managers have lost complete connection with the equity investors. And he was absolutely right. The RJR Nabisco of 1986. I'm not sure the managers even thought about their shareholders for a second because manager-owned company. Which brings me to the third argument for borrowing money, which is expected bankruptcy costs. The keyword is expected because there are 2 components that go into it. First is the probability that you will default on your contractual payments. And the second is what the cost is of defaulting. You think it's obvious, the company ends. I'm going to flesh it out. It's not as simple as that, but it's probable. So let's take the first one, the probability that you will default. Let's take 2 companies, they have the same, let's say they have the same operating income, $1 billion. And they're both thinking about borrowing money. But one is a company which has volatile earnings, and the other is a company with stable earnings. Just focusing on the probability of bankruptcy, you can see the company with uncertain and volatile earnings is more likely to go bankrupt, even though the levels are the same, because things can change much more dramatically. So already we have an implication, right? For any given level of income, companies with more uncertain income streams should borrow less than companies with more certain income streams. So file that away. But let's talk about bankruptcy cost. What's the cost of going bankrupt, humor me? What happens?
Chapter.
You end up, the minute you say chapter, somebody else enters this game, right? Where do you end up? You end up in the court system. Incredibly efficient system, right? Not. I still remember when I became a citizen of the United States in the 1990s. 2 weeks after I became a citizen, I get a letter in the mail reminding me of one of my duties as a citizen. You know what the letter invited me to, right? Jury duty. And to show you how naive I was actually excited about the prospect. So I put circle the day on my physical calendar. Remember, these were the days before. And I show up expecting balloons and a cake, inviting me to. So what I walk into is, of course, this dark, dank room where this lady sitting behind a table, she said, and I said, look, I'm here for jury duty. So go sit in that chair. I said, what do I do? Watch the terminal. So what am I looking for? Your number. I said, what number? There's a number on your, and they said, what happens if the number doesn't come up? She said, you have to come back tomorrow. I said, I can't keep coming back day after day. She said, don't worry, we pay $12 a day. I said, that settles it. I'll come back for the rest of eternity. But it kind of gives you a microcosm of how the legal system thinks about the value of time, right? The only people whose time is valued in that room are the lawyers in the room, but everybody else, time. I mean, would you have wanted to sit on the grand jury looking at whatever they're looking at, I mean, imagine how many days of their lives. It's Tuesday, Wednesday, Thursday. They've been meeting for like 2 years. What did you do with the rest of your life? But once you're picked, they can put you behind bars if you refuse to show up, I guess. But my point is, that's one of the costs. It's a direct bankruptcy cost. It's a deadweight cost. And while you're waiting for the system to unfold, the only people who are getting paid are the lawyers. It's estimated that in bankruptcy, 30 to 50% of the value of the company goes to covering legal costs. My son, when he graduated, went to work for an accounting firm. I won't name this. I talked him out of accounting. He was working the appraisal section of the firm. So about 6 months in, I had to show that I was interested as a dad. And I said, what are you working on? And he said, the Lehman case. And I said, what? This is 2019. The Lehman case was 2008. You know what? The Lehman case was still dragging on in 2019. Collectively, the fees in the Lehman case worked out to $2 billion. It's a deadweight cost of bankruptcy. That's something you got to factor in, right? Yeah, it took forever. 14 years after the fact. That's it. If that were the only cost, though, I would encourage companies to borrow more. What I worry about is what I call the indirect bankruptcy cost. You know what indirect bankruptcy cost is? Let me ask you a question. If people think you're in trouble, are you in trouble? Yes. Yeah. Let's take your customers. If customers think you're in trouble and you sell refrigerators or cars, what do? They say, look, stop buying in the first place, right? How do I get spare parts for a car if you're not around anymore? So your sales get affected. What do your suppliers start demanding if they think you're in trouble? They say, look, cash, no 60 days with you. What do your employees start doing? Checking out monster.com or wherever you go to look for jobs anymore, because they don't know whether they'll have a job. The whole thing starts to unravel. Indirect bankruptcy costs can be huge. And if you worry about their presence, you don't even want to get close to indirect bankruptcy costs. So let me give you 3 groups of companies, and you tell me which of these, based on this probability of bankruptcy and indirect bankruptcy costs and bankruptcy costs, you would expect to borrow the most money, and which ones you would expect to borrow the least money. So the first is a grocery store business. You can make it Kroger's or any grocery store chain. The second is an aircraft manufacturer. The third is a high technology company. So let's start easy, based just on indirect bankruptcy. So let's say all 3 companies are the same level of income. So we made them equal. Which of these 3 companies should borrow the most? And what is it about grocery store businesses that allow you to borrow the most? First is it's non-discretionary. So even when they have bad years, you don't get the swings you get in other retail. It's pretty reliable. And let's talk about bankruptcy costs. I don't know about you, but No, when I walk into a grocery store, I don't stop at the door and say, is this a AAA rated grocery store, a triple B? Frankly, I don't care. Why? Because I don't plan to bring the lettuce back in 5 years. As long as the store is open for the next 5 days, I'm okay. It sells these short-lived products where people really don't care about distress risk as much. I'm not saying there's no direct, but I'd expect grocery stores to borrow the least. I expect aircraft manufacturers and high technology companies to borrow less, but for different reasons. If you're a high-tech company, you're a growth company, you have enough income, why might you choose not to borrow money? What aspect of bankruptcy cost is holding you back? Is it the probability that you can go bankrupt or the actual? I think it's just your earnings are so volatile. That alone is going to hold you back. So when you're looking at a technology company, it's just the fact that you might be making a lot of money, but you're holding your breath. Say any day now that could disappear. And an aircraft manufacturer has incredibly high indirect bankruptcy costs. I mean, let's take a company like Boeing, right? Think about a typical contract for Boeing. It'll be a 20-year contract with Singapore Airlines to deliver what 18 Dreamliners or 25 Dreamliners over the next 20 years. There is zero chance that Singapore Airlines is entering into that contract with Boeing if it is a double B rated company or a single B rated company, right? Because who's going to make sure there are parts for these aircraft? Indirect bankruptcy costs are huge. And that's why when Boeing got into trouble in March of 2020, the peak of COVID, there was such concern that it wasn't that they couldn't make the next interest payment. It's that their entire business model could start to unravel if people thought they were in trouble. In banking, of course, you see this play out. The unraveling can happen overnight, right? How quickly Credit Suisse went from everything's okay to the whole thing spins out. So bankruptcy costs basically capture that. And I'll at least list out the last of the cost because we'll talk about this on Monday. Yeah. Which is when you borrow money, you give up flexibility. So when we come back, we're going to complete this cost trade-off. It's qualitative, but I'd encourage you to think about this for your company. I know you picked a company, so don't tell me I haven't yet. You picked a company, revisit it, at least from a qualitative perspective, ask yourself, is my company the kind of company that should be borrowing money?
Through all the time. We go for every. We go. Yeah. The time we started.
What happened?
And that's what I mean by intellectual property. It's still acting like it's 1940 stuff, right? Or their technology business. Everything we have written only in that it's the game is
Thank you.
But if you parcel off the debt and all off the risk, then nothing to get that. Yeah, it's the most predictable income, and it's the least worried about it being trouble, the stress, you're consumed by your project. It's not discretion, because you learn to think, but it's also the argument that you think that can't keep the cost on low. Because you don't think it's very constant. Both, you know, that, so for different reasons, I would expect to the aircraft that, you know, that's in there, that would be, it's more, show business, but it's not really going to be there, that we can get there.
Hi, we're still on the course, 30, and then. Let's go.